Hi, and welcome to the Trading Bell Show. Glad that you have joined us. Now, KenyaRe's have released their results, and we are glad to host the Group MD, Dr. Hilary Wachinga, to unpack the numbers and much more. Dr. welcome to the show.
Thank you so much.
Yes, that's a very firm handshake. I believe this is good news. But first of all, welcome to, this should be your inaugural one on the Trading Bell, and we appreciate you.
Yeah.
And really wanted to start the conversation by asking you how this sector, especially on reinsurance, is doing. Just looking at the environment, the macroeconomics, how are you guys faring on?
The sector is doing quite well.
Yeah.
It recorded a double-digit growth, and mainly informed by the growth of the direct underwriting activities.
Yes.
Again, anchored on a resilient economy. The macros are right now.
Yeah.
If you look at inflation, for instance, it's at a record low, around 4%. That is way below the central bank threshold of around 7.5. Again, if you look at our currency, it has been quite resilient.
Yeah.
Despite the political and economic upheavals here and there. Okay. You discover our shilling has really appreciated against the major currencies. Okay. Oscillating between a low of 125 to around 129.5, a high of around 131. Yeah. And if you compare that to the same time last year, you actually see that is now the true value of shilling. Is almost the servicing right now. Yeah. Then when you look at interest rates, again, I'm sure you know there was some revision the other day, which again will increase the affordability of insurance, especially by, again, direct underwriters. Yeah. So we expect the industry to sustain its tempo for the rest of the year.
You know, looking still at the regional perspective, sometimes we are still touted as some of the people that have some of the lowest entry to the insurance, which directly as well has an effect on your operations and all that. On a regional perspective, are we improving? What have you seen over in terms of the trends?
Very good question. It's true. We still have among the lowest penetration rates globally. It's still below 3% compared to double digit in South Africa, double digit in Morocco, for instance, and other developed countries. But Kenya is still the leader in this region. And again, when you look at that as a measure, it may not be the right way or approach to assessing insurance penetration. Okay. Because if you think about it, the rate may be low because the uptake of insurance may not outpace the economic growth rate. Okay. Meaning, if the GDP is growing faster than the insurance premiums, then the rate will still be suppressed. Okay. But if you look at it, our economies are growing quite fast compared actually to other regions. For instance, across East Africa, you come to realize we are projecting minimal growth of around 5.5%. Now, if you think about it, I'm talking about penetration of below 3%. So at no one time you can want to think about it like that. But in essence, is to realize the space is actually expanding. Okay. The space is expanding in Kenya and other 6 East African countries. Yeah. So the space is actually improving.
All right. Yeah. Which is very good and positive. So let's get a bit into your numbers. You released your results, and wanted to go just check on your profitability and revenue growth. Your report shows an increase in the gross written premiums compared to the previous year that you had reported. I wanted to know what are some of the key factors that contributed to this performance?
Yeah, I'm going there. Maybe to start with this, to give you an overview of our performance. Okay. Yes. I may not go to numbers. I'll give you percentages. Yeah. So if you look at our top line, our top line went up by 20% based on IFRS 17 numbers. Okay. Then our technical results, that is underwriting profitability, actually went up by 388%. Okay. Then when you look at investment income, again that went up by 26%. However, all that was offset by appreciation of the shilling against the dollar. So we had a hefty knock of around 800 million. Yeah. But if you look at the overall performance, our numbers only dipped by around 116 million. Okay. which we expect to cover in the course of the year, between now and the end of the year. Yes.
All right.
Yeah.
And I love that general overview and looking at it. But even from your statements, looks like FX hits you big time.
Yeah.
And I don't know whether we have stabilized yet, or from your perspective, do you see whether we have stabilized? Because yes, we are coming from a very volatile time and season, which you reported based on.
Yeah.
And looks like it hit your books much more. How is it now? Are you feeling there's a level of stability, and will this affect probably in the positives you're reporting in the next time?
To start with this, to say last year was an abnormal year. I think we have never seen such abnormality in the movement of Forex. Because moving from a low of around 130 to a high of 161 in 1 year is something that you may stay for a very long time before seeing.
You're right.
Okay? We have seen, again, the exchange rates now settling, as I said earlier, to a low of around 125 to 131 between now and the end of the year, because we use various tools to, again, forecast this. We don't expect it to go past 135. So, again, going forward, we may see a very gradual depreciation. Over time, but not to the highs of 159, 161. Okay? That is over the next 2 years. So I want to believe it has stabilized. It has stabilized. But to mitigate against that, we try to do a lot of natural hedging. We have significant dollar reserves, and maybe is to give a glimpse of where this came from. So as a corporation, we source business from around 83 countries. Okay. Then we have also diversified our investments. So we have a lot of dollar-denominated assets out there. And when you do revaluation, again, when you translate, because we also have subsidiaries, you have all these exchanges hitting your books. But as I said, between now and the end of the year, among the measures we adopt are simple measures like trying to protect the dollar and make significant payments using the shilling. So again, trying to just avoid any conversions. But again, as I said, I don't expect a lot of volatility in the course of the year.
Fair enough. You've spoken and touched on your investment portfolio, and looking at your numbers, especially on the investment income, I noticed some fluctuations in investment income, and I wanted to ask you, could you elaborate on your performance on your investment portfolio, and maybe what strategies are in place to enhance returns, given the current economic environment?
I expect our investment income to actually improve. As I said, by half year, it went up by 26%. If you look at the historical performance of our investment portfolio over the past 10 years, you will realize we have sustained double-digit growth per year. Per year. And
well done on that.
Per year. And I'm also sure you have seen we have a double-digit ROI consistently over years, because we are quite conservative in our approach. We try to really balance between the risk and the return in a way that will protect our bottom line. The volatility you are saying mainly, again, was affected by some changes in interest rates and again Forex, because as I said, you have diversified by region and by line of business. But again, what I can assure you is by the end of this year, again for full year performance, you still see a double digit. Yes.
Lovely
growth.
Excellent. And you know, it's a great focus, especially even to the investors out there. One of the things I wanted you to touch on as well is on the claims ratio. I saw some conversation going around the claims ratio. Would you shed some light on it?
But again, we actually call it a loss ratio. And basically you are looking at the claims payouts compared to the reinsurance revenue that you're writing, or basically the risks that you're accepting. We have internal thresholds to contain these at a high of 58%. That is basically our internal risk appetite. But if you look at half-year performance, you come to realize we are at around 43%. Which is almost the market average. And to contain it, we've been making strategic decisions. Okay, I'll tell you, like for instance, over the past 1 year, more than 1 year, we made a decision to stop writing 2 lines of business from some markets. Okay. So we decided to scale down on agriculture and then on medical lines because they make a lot of losses compared to the revenue you are getting from them. And again, when you realize you have a new standard, you have a standard we are calling IFRS 17, that and IFRS 9, you are applying both of them at the same time. There's a lot of incentive to just focus on profitability, not volumes.
That's true.
Okay? So again, we also do a lot of modeling internally, especially when we are pricing. We're able to predict at the point of accepting a risk whether this will make a loss. Okay, and again make a decision not to take it. So if you look at that mindset alone, is what mainly informed that 388% growth in underwriting profit. Because again, the focus is no longer on the top line; it's about bottom line. Meaning we are quite selective in the way we are accepting business, and also focusing on what we call prudent underwriting practices. So the focus here is so much on making sure the contracts we are taking are aligned to the mindset of IFRS 17 and are not they are not loss making. Yes. All right. So if we are to be hit by a loss, it's on the worst case scenario. Yes.
Okay. Yes. You know, as usual, this is one of the things I sometimes always highlight every time we are coming in, even in the banking sector as well and all that. Operating expenses. I normally don't envy CEOs because most of the times they have to have all these changes that come up by, and they have to still maintain the balance on ensuring that their operating expenses are in a very optimal manner. I want you to shed some light on your operating expenses and how you're faring on in that sector based on the reports that you gave us.
Very good. Again, that is an area that we monitor internally, but also it's highly regulated. So you find the regulator insisting you must maintain a certain margin of your management expenses. Actually, there is a ratio. It's called management expense ratio. That when you look at the expenses you are incurring to generate your business, they must be contained at a certain percent. Internally, we maintain that at 9%. And if you look at our half-year performance, it was actually around that score of 9% or so. But the spike you might have noticed is because of another one expense that we have just discussed. Forex.
Forex again.
Forex again. The 800 million plus is actually inside that line.
Wow.
Yes. So that is why, again, we are trying to burn our midnight lamp to ensure we close the gap between now and the end of the year. And because we don't have control over Forex movement, the only way is to make sure our investment income grows significantly, then underwriting income also grows significantly, so that you have enough cushion to absorb any adverse Forex losses.
Just top of mind, you must be at a heightened sort of like risk perspective and viewing things in a way that will not put you in such kind of risks. And I just wanted to ask you, looking at the offing, and even as you're now nearing to end the year again, and I believe, as you have said, you're very optimistic on how you're going to end it. How are you planning, you and your team, to ensure that you have mitigated the risks that you may have foreseen?
To start with, we have a quite a robust risk management framework, which we apply in all aspects of our business. And maybe a brief on my background. I'm a professional risk manager. That is what I used to do before becoming the CEO. And what we try to do is we proactively, not reactively, proactively manage our risks. As I said earlier, for instance, underwriting risk, you actually embed that at the point of accepting a risk. All other aspects of risk management, you have now predefined mitigations. And when I say we still expect to have a very good performance, is because we have now identified all our pain points and proactively done something about it. I may not want to disclose everything, but what I can assure you is we are on top of our game.
I want to put you on the spot. I know there are many things that could keep you awake to ensure that everything is fine. What's the one thing that you know you're really keeping you awake?
A very good question. A very good question.
Yes.
And the industry we are in is now faced with a lot of what we are calling emerging risks.
Okay.
Things that traditionally have never hit our performances. Things that we may be very thin on as a region. And I'll give you an example. We have what we call catastrophic risks. Okay. And these are mainly major events, mainly climate weather related exposures that used to have a remote chance of occurring. Now all of a sudden, the likelihood of them occurring is now quite frequent. So you find if it is a flood, the way it is happening now, it might come again several times. The frequency is actually shorter than before. And when it happens, the severity, the impact is quite huge. Okay? Now you find in our shores, we rely so much on international support system to help us understand and price that risk. Okay. Now, even if you got a solution, again you find we don't have enough data sets. Okay. To accurately now guess those two parameters to price it well. So, if for instance the other day you saw some earthquake. Okay. You can never tell with certainty the magnitude, how far it can go. Now, if it were to occur again, you may find a lot of the people we are insuring most likely had not taken any protection. Okay? And on our side, because we deal with that headache, okay? We rely so much on estimates. What we did is we go out, we try to model that. And again, because the modelers may not have enough data, we usually set aside what we call a buffer. So when we are taking protection on that, we assume because we don't have enough data, and the assumptions on modeling may not be right, why don't we just take additional cover? So right now we have excess cover on that. Okay. So in case anything was to happen that is outside the normal, we are usually cushioned. Okay. So we try again to be conservative in all aspects. Okay. Then there are the macros that we may not control. Okay. Like what happened the other day. You may not foresee things like the political upheavals that happened the other day. And in the process, as we sit here, we are monitoring development of claims that are coming from that. Okay. Again, this is so punitive considering floods happened the other day. Okay? So you find the business we are in has so many moving parts that you may not accurately predict. And what we also do is we maintain reserves, adequate reserves, just in case. Okay. So at times you may feel like you are holding too much, you are over-reserving, you are prudent, but other times you may ask yourself, am I tying up capital? Am I sweating my assets enough? Okay, but again, that is the nature of our business. So at night you may wake up and start thinking thinking about it. But that is the nature of our business.
No, fair enough. As we come to a close of the conversation, shareholders are looking up to you to make them something, and I want you to address the dividend and what you have given them. But even as you address that, how are you balancing the fact that your industry has to constantly ask you to keep innovating and all that, so reinvesting the capital versus still rewarding your shareholders? How are you navigating that as we talk about the dividend you have given them?
It's a very good question. It's a very good question. If you look at what we gave them last year, we increased our dividend payout by 50%.
Impressive.
50%.
Impressive.
Okay. And we wish to continue that trend. Okay. At the same time, we also remember, again, the business we are in is quite unpredictable. Okay? You may wake up tomorrow and find a huge claim, and you don't want to go looking for money to pay a claim. So we conservatively, again, try to distribute as much to keep the shareholder happy, but also keep the business sustainable. Okay. At the same time, there are some developments that you may have seen that have impacted on that. Being a quasi-government operation, I'm very sure you saw some communication. We expected to distribute 80% of our dividends, of our distributable profit. And we fully complied with that circular for 2023. Actually, I think we were among the only government entities that complied with that. In the process, shareholders, of course, smiled all the way to the bank.
Yes.
But we may want to engage further and with our stakeholders, because we may not be able to sustain 80% payout. But again, when you look at it, what we distribute is only cash rate. You adjust your profit for a lot of non-cash items, like when you look at things like unrealizable forex gain or losses, unrealizable revaluation again gain or losses, things like now the surplus for life business is not distributable. Things like amortization, depreciation, you remove all those things. Then what is left is what you distribute. Our traditional dividend policy was 30%. That is in line with so many other companies. But again, as I've said, 2023 was a quite interesting year. Abnormal macros. Then again, we raised the highest ever profit since 1970. And now the government's directive to distribute 80%, and we managed all that. All that. So again, we expect to meet the same high standards as compared to last year. Ours is a promise to close the gap on this 116. Maybe what you may not have realized at half year. We don't put a lot of things to our performance. I'm sure you show we are thin. There are some missing numbers, like revaluation gain on investment properties. And other components that come at the end of the year. So at the end of the year, you'll be seeing a very interesting performance. Media.
I'll come to see you. I'll come to see you so we can talk about the full year.
So you'll be seeing a lot of changes, but most likely will not be that far off from what we wrote last year, what we reported last year.
Well then, my final question will be about your focus on expansion and diversification, because you're in a place where product diversification is more, whether there are anything that you're putting in place. And maybe you could finally as well touch on your sustainability aspect and what you're doing as a company on that area. Please go ahead.
I'll start with the first one on market expansion. Sure. This is an area we are very keen on. I'm very sure you saw around June we raised additional capital. We did the bonus issue and got $100 million for expansion. So we have a watch list, $100 million. And we intend to go to blue ocean markets that we have identified. So part of that capital will definitely go towards setting up new allocations in markets that are not that competitive, that are underserved. And again, we make decisions purely based on a lot of data and of course financial feasibility studies. Then part of that capital will go towards meeting new regulatory capital requirements in markets like Egypt and Tanzania. And we expect that to give us now diversification by region. So currently we still distribute our traditional products. But we are in the process of designing new ones. Most likely before the end of the year, we are going to invite you to launch our launch of new products. We are at the tail end of rolling out 2 new products. Most likely by the end of next week. We will let you know. But we've been working very closely with the regulator, with the insurance companies, and with some brokers. We are also looking at innovation, and this is from product to now distribution. For instance, again, we are using IoT. In again distribution of one of those products that we'll be launching. And this product will touch on 7 countries of East African community. Then beyond this region, Again, as I told you, we are in multiple regions. We are getting business from 83 countries. We are also working with those markets to identify unique solutions to those markets.
Okay.
So we work very closely with brokers, also very closely with insurance companies to tailor-make solutions in those areas. Okay. Your last question was
on sustainability.
On sustainability.
Yes.
Again, that is an area we take very seriously.
Okay.
We don't do it because it's a new trend that every other person is doing.
Yes.
We do it because we believe in it.
Okay.
So if you look at our underwriting practices, we revise them to embed ESG.
Okay.
Okay. So if you look at, again, the way we select risks, you might see some businesses we used to have in the past and we are dropping them.
Okay.
Okay, so this is good business, profitable business, but again, because it is not ESG compliant per our internal standards, we let it go. Okay, we also apply this in other aspects of our business, like investments. Okay, I will tell you, if you look at our investment portfolio on equities, you discover there was a very profitable counter. I don't want to name it.
Yes.
It's the biggest cigarette maker in Kenya.
Okay.
We had to exit from that. We had to sell off those shares.
Yes.
Because again, you ask yourself, what activities are they in? Do you really want to continue enjoying profit from that source? So again, you dropped it. Okay. Okay. Then internally, we also set up an ESG department. We have an ESG policy. And if you look at other aspects, especially the G, you come to realize we are among the only boards of listed companies whose chairmanship is a lady. And also senior management, we have a lot of ladies. Okay. So if you look at our workforce currently, you discover we have very good gender diversity, with 60% of our workforce, of course, represented by ladies. Okay, but again, this is a journey. This is a journey. We have also been training the entire market. I don't know whether you are aware of KenyaRe's Academy.
I've heard of it.
We have one, and among the trainings we offer there to the entire insurance sector is ESG. And we have gone out of our way to appreciate. This is new to us. So we have hired a resource. Okay, I think the best of the best in this market to partner with us. Okay, and apart from setting up the entire framework internally, he's also now training the entire industry from KenyaRe's. Okay. So we take ESG matters very seriously.
Wow. Dr. Hilary Wachinga, thank you so much for your time.
Thank you for hosting me.
Absolutely.
I look forward to, again, our launch.
Absolutely.
And I'm sure you don't mind passing by to get a better understanding of our numbers and, of course, our strategies.
We want to see those new products, those new innovations, and full year results as well. So that's a promise for another conversation.
Sure.
I'd like you to just, in a sentence, what do you tell your shareholders? What's your word looking forward as you come to close the year? What would be your last word for them?
I may want to tell them... because we issued some bonus, we did a bonus issue, one-to-one, I may encourage them to buy more shares. If, again, and I'm not saying this for the sake of saying it, if you look at the value of our share, okay, ours is among the highly undervalued counters, if you look at it critically. And this is the best time to buy because we are at the lowest. I think we are trading at around 1.5. Okay, and this was before the split. Over time, it will go up. Okay, if you look at our fundamentals as a company, they are right. Okay, again, if you look at, for instance, if you want to have a glimpse of our share, our market cap right now is around 4.5 billion. Now think about that. That you're valuing a company of our caliber at 4.5. Do you know 4.5 billion is not even the value of 2 of our properties. If you look at Anniversary Towers, we own Anniversary Towers, the value is around 3.8 billion. Already. Okay. If you look at the Reinsurance Plaza, the value is over 2.5 billion. So 4.5 billion is serious undervaluation. Very. Again, if you look at our numbers, our volumes, our investment portfolio, for instance, 2 sure things like government securities, we are talking about double digit in billions. Fixed deposits with banks, double digit in billions. Okay? And again, if you look at the resilience of our performance, is over the past many years, from the time we issued our IPO, we've been retaining our retained earnings. Have actually now cushioned our books. Again, is anything that can come between now and the next like 30 or so years.
Okay.
So I'm encouraging my shareholders, telling them to take up more shares, and also promising them that ours is a solid company.
Excellent.
And with an assurance that we will give them a better performance than last year. The worst case scenario is actually matching our performance last year.
Wow.
Yes.
Wow.
Yes.
Very optimistic. There you have it. Dr. Hilary Wachinga, very positive and saying, listen, this is the best time to check them out. And they have everything on the table laid out for you as a shareholder as well to take it in. That's it for now. We'll move on and we'll leave you with the markets and much more later on. See you later.